All right, so how does Tradespoon help you? Well, we have models, right? If you want to keep emotions out of the equation, I would say Stock Forecast Toolbox. It's the great model because it doesn't look at any emotions, nor it doesn't look at ECB decision. It doesn't look at the Fed decision. It doesn't know when they're going to occur. It's not trying to predict what Mario Draghi will say or what Powell is going to say. So you basically look at spiders. It says positive trend, 438. If you're a short-term trader, consider buying. 450, consider selling. Very useful information, right? So we are in uptrend, right? Why are we in an uptrend? Kind of intuitively, you can understand this, right? If you do this Fibonacci retracement, right? If you do the same thing that we just did on the chart with technology, right? Recent high to recent lows. We are above 50%, right? 50% retracement is 438. And magically, actually, it does show you that it's 438 without doing Fibonacci retracement. This is different methodology. So 438 is a very strong support for the bulls, right? As long as market is trading above 438, we are in the uptrend. Bulls are winning. And if you're short-term tactical trader, consider going long at 438. If we reach 450, consider going short. Why? Well, you see that if you print January high to January low, 450 tends to be longer term overhead resistance. So market is stuck in this range between 450, which is a 50% high to low, January high to low. And then if you look at the previous 2 weeks high to low, support is 438. So you will see buyers stepping in at 438, sellers will step in at 450, and model gives you that information. Doesn't mean it's always right, 100%, no. All it means, these are the main support and resistance levels, and you will see bulls and bears fight through these levels. And if you're a day trader, you buy at 438 and you sell at 449, right? That's the strategy. Now, if you want to zoom out, and you want to look at not a 10-day prediction, but 6 months prediction, right? One of the most common mistakes for new traders. New traders, and I know how long you've been trading because when you open up a support ticket, they look at this support and resistance level, then they look at the 10-day vector, and they say, Vlad, on February 17th, models say market is going to reach 467 level. So I bought calls today because market is at 444, and I expect the market to go up 22 points. And then on February 17th, you open up a ticket and say, Vlad, market is at 433. How can the model be so wrong? And people get upset, like they're really upset about this because it makes sense. It's a confirmation bias, right? When model is right, then you think it's because you're such a good trader. And when trade goes against you, it's because the model is not good, which is totally fine. It's okay to blame the model. I always blame the model too. It's just our human nature. But it's important to be self-aware and realize at least limitations of any statistical and modeling analysis. First of all, you have to at least understand that nobody can predict where the market is going to be on February 17th. If you think that you can subscribe to some service or some model that will accurately tell you where the market is going to be on February 17th, you haven't traded long enough, right? Or you haven't tried enough services to at least come to a realization that market is random. There is a random portion in market that you can predict accurately trends. You can predict accurately trends up or down. You can predict accurately support and resistance levels accurately, but you cannot predict where the market is going to be on February 17th, March 25th, doesn't matter. You can say, I think market is going to break through the 480. You can accurately predict that, or you can accurately predict that the market will break through 420 in a certain period of time. Or you can look at, statistical analysis and say, market will gravitate toward these price distributions, but there is no way anybody can tell you where the market is going to be on February 2017. So this is the most common mistake. Better way interpreting this information to say that What is the low for the next 10 days? 433. What is the high for the next 10 days? Maybe I would, if you're bear like me, you say 467. I would say for the next 2 weeks, you sell. If it does reach 467, it might, right? It might be, tomorrow, if the Fed comes out and says that, inflation is easing, right? Or next February meeting, right? In fact, next February meeting, when Fed meets, in the months of February, and they're going to say, you know what, we actually see evidence that inflation is easing, right? Like Apple announced that, they expect all the supply chain issues to subside by March. And if Jerome Powell says something similar to what Apple says, market is going to be at 467, right? So it is possible, but that doesn't mean it's going to happen on February 17th. So the model tells you the range where it's going to trade, and it gives you this collection of vectors, basically giving you what is the current bias. And that's all you can rely on. And that's all the trader should need. The trader needs to know, are bulls winning or are the bears winning? And what is the possible range? At which points do I buy and which points do I sell?